Hi everyone, welcome to the Global Macro Edge. This is Fotis speaking from the Fotis Trading Academy. The purpose of the Global Macro Edge is not to go deep into the world of macro fundamentals and economic analysis. We have a clear objective in mind, and this is to understand what is driving price action, what are the catalysts that are affecting the markets, so we can see where to focus for the coming weeks, the coming months, and identify high probability setups and trades. So let's begin our exercise for this week. It's July the 9th of 2018. So let us do it. Now, this week we are paying attention to the following factors. You will notice this table right here. And on the left side, we have macro fundamental indicators. We have developments that have to do with economics. On the right hand side, inside the green box, we have developments that have to do most with political and geopolitical themes. We can understand and apply some predictive modeling and forecasting when it comes to factors inside the blue box, because of course we are related to fundamentals and we can understand and model them better. But when it comes to catalysts that are inside the green box, it is a little bit more difficult because these factors are affected by political developments, geopolitical themes, and they are a little bit more unreliable. We cannot predict when Trump is going to send a tweet and upset the whole world. We don't know the outcome of Brexit. We cannot completely understand how populism and the migrant crisis is shaping Europe. The outcome of any trade war in G7 and the tariffs that they put on each other. We don't have control on this. This is, to a certain extent, unpredictable. However, when it comes to items inside the blue box, the pace of a tightening cycle in the US, what happens with US growth, Euro area growth, tapering of QE, the Chinese economic slowdown, the global growth slowdown, the answer to the question whether global equities have peaked out. We can answer them with more confidence. Why, you might ask? Because we have a model, because we have a fundamental framework that can help us understand this, because we have the release of many economic indicators that track the economy. So we can see where we are going, we can see where we have been, and we can see where we are going. And of course, the purpose, as I explained, is not to go ahead and do a very extensive economic analysis that only an economist would understand. The purpose is to understand where the opportunities lie on a practical basis. So let me move on. Now, the major macro themes of interest, I'm going to focus here inside the blue box: economic developments, macro fundamental developments. My focus is here, the pace of a tightening cycle in the US. The Fed has said they are going to raise interest rates. How fast are they going to do it? And what are the implications of higher interest rates in the actual economy, in the real economy? What happens with US growth? What is the truth? Is the US economy really growing? Or shall we be worried? There is a divergence there between hard and soft economic indicators. Euro area, when it comes to growth, is a disappointment because after Emmanuel Macron won the elections in France, we had high hopes about Europe. They were surprising us to the upside when it comes to growth, when we were looking at economic activity, especially after the end of the Italian elections and the election of Emmanuel Macron as the leader of France. We had high hopes, we had very good economic releases, very good indicators, and now it's completely the opposite. They disappoint us with the growth figures. What happens with the QE is when is the ECB going to put the brakes on? Is it going to happen inside the first half of 2019? Do they know something that we don't? Is there any scenario where the QE is going to be extended, as some ECB forces released to the press, they talked about buying long-term bonds also into 2019. That's more accommodative measures. That's not tapering the current QE. A huge factor is the Chinese economic slowdown. While the major financial media are paying attention to US, to Trump, to the European political crisis, to Eurozone, it is China that matters. China is extremely important for the global economy, for global GDP growth. Very important, and we clearly notice signs that China is not only moving into potentially a serious slowdown that could turn to be a recession, but the Shanghai Composite Index is officially in bear territory. Does this matter for global growth slowdown? This is what we are going to answer and find out. What happens with global equities? Are global equities peaking out? So I'm not going to tell you just my opinion. I will try to be as less biased as possible, but let me show you the actual data. So let's move on. Look at the next slide. This is from Haver Analytics and IMF WEO. It was released on April the 8th. And this is a fantastic chart. So well done to Haver Analytics and IMF WEO. They identify, and this is the truth, that China remains the swing factor in global growth again this year. If we pay attention to the composition of the 2018 real global GDP growth, you will see that China alone makes 31% of global growth. China is accountable for 31% of global GDP growth. The rest of the emerging markets are making up another 43% of growth. US, United States, is making up only 11% of global GDP growth. So you can see the importance of every major economy in global GDP. China is responsible for 31%, other emerging markets 43%. So let me add the addition. So that means China and emerging markets alone make up 74% of global GDP growth. US is making 11%, and I think the rest could be attributed to Eurozone and other nations. So you can see that when it comes to China and emerging markets, they are responsible, they are the swing factors when it comes to GDP growth, when it comes to how they affect the global economy. So what happens now in the world when you see that China, as they like to say, is sneezing? China looks to have a cold. They are trying to gradually soft land their economy. They are moving from an export-oriented model towards a model that focuses more on the domestic economy. And they have plans, very long-term plans for the next 5 years, the next 10 years, and so on. So what they are trying to do for the next couple of years, I think they are trying to soft land the economy and move to another model from an export-oriented model to a model that focuses on domestic consumption. How are they going to do this? They are trying to deleverage their economy, which was leveraged to the max. You cannot possibly imagine how much leverage we had at the Chinese economy. And they are trying to do it with the least impact on GDP. Of course, this is not a win-win situation. You cannot try to deleverage your economy and at the same time to enjoy a high GDP growth. So we can see that growth is taking an impact in China, and that was clearly seen when the latest manufacturing PMIs came out. And we can also see this in the domestic activity. But this is a good decision, that it will be good for China in the long run, because we had a massive dark black banking system that was leveraged to the max and that was putting at some serious threat the Chinese economic activity. You couldn't possibly consider yourself part of a global economy and have this shadow, dark, black banking system. The Chinese government needed to do something, and this is what they are doing now. Now, the impact, of course, is that we have a slowdown in GDP growth, and of course, their actions are affecting the other emerging markets. We have growth slowdown in other emerging markets. Now, because this is happening, because a political decision, that I think it is the right decision in China to gradually get out of the old model and into the new one. However, of course, this is affecting growth, it is affecting emerging markets, and guess who else is affected by this? This is something that I haven't seen too much on the media. Why do you think we have this severe, I would say, slowdown in Europe? As soon as emerging markets and China began this slowdown in their economic activity, also Europe was affected, because the main force in European economy, this is Germany, is having an export-oriented model that of course is very sensitive to lack of demand or demand from emerging markets and China, and also it is very sensitive, it is affected by international trade wars. We can say that Germany resembles South Korea to a certain extent. So this is very important. These are factors that you need to pay attention, because in my humble opinion, this matters the most to the global economy. Take a look at the next chart. This is the Shanghai Composite. So you can see that China decided to stop the party, no more accommodative measures in their own unique style and way, no more free money. They decided to tighten conditions and do something with the shadow banking system and deleverage the economy. So because of all these actions, there are other factors like international trade wars, the fact that US interest rates are moving higher. Take your pick. For anyway, we had a series of factors that they weren't positive for equities. So you can see the Shanghai Composite. This is a daily chart. Sorry, this is a weekly chart. Let me correct this. This is a weekly chart, and you can see the 52-week moving average. You can see that prices have corrected almost 20% from the highs. That puts the Shanghai Composite officially into bear territory, and we are approaching a very important support at 2,600. This is an important level, because if that breaks, this is the low from 2016. If that level is taken out, then I think we could head towards the 2000 level, and that could spread panic and unrest, not just in China, but also in the rest of emerging markets. And now with globalization, you understand why this is important and why it matters also for other markets. So, fact number one, Shanghai Composite officially in bear territory, and this is something that we need to watch. Let me move on. This is the canary in the coal mine for me. It is copper futures. When we were at the highs over here, around the 331 level, something like that, we had said pay attention, because the structure of the market is balanced. We have sideways activity. It looked very likely that we were going to have a double top formation, and this is exactly what happened. And when we see a situation like this, that copper is strongly moving lower, it means that our scenario that calls for global growth slowdown accelerating, it is true. Because usually when we have demand and growth in emerging markets and China, we have demand for metals like copper and other industrial metals, because we have an expanded economic activity. However, we don't see this. We see copper suffering. We see copper moving below the annual moving average. This is daily, and we have a 200 MA. It has moved below, it has broken out of a range. This is a very bearish chart. Every time, if we have a correction, we will be looking every time to sell into resistance. As long as it stays below the bottom of the channel, if I can see correctly, it's around 2.9375. We are very bearish on copper. So we remain bearish on copper. That agrees with our scenario that China is going to face some serious turbulence ahead, and this is also going to spread in emerging markets. So this is one theme that we are watching and we pay attention. Now, next chart. This chart will help us understand why emerging markets were suffering. Well, I think we have answered this so far, but it helps us understand why also there was demand for US dollar. So put everything together. The Chinese government has decided to move away from an accommodative policy and do something about the extreme leverage in the economy and shadow banking. They are moving more to tighten conditions and being less accommodative. This is affecting Chinese equities. This is affecting emerging markets. We have an understanding, and this is affecting sentiment globally, that we have a global growth slowdown. So what happens with emerging market currencies? Emerging market currencies are suffering. Why? Because they go into risk-off mode. You can see this is CEW. This is from an ETF from WisdomTree, Emerging Currency Strategy Fund. The symbol is CEW. I think this is a weekly chart. Yes, this is a weekly chart, and we have the 52-week moving average. You can see that as the Chinese altered their monetary policy, and this affected emerging markets as well, emerging market currencies are suffering against the US dollar. Of course, you can also claim, and that would be true, that the fact that US interest rates started moving higher, especially the 10-year yields towards the 3% level, that was not good for emerging markets. Why? Because emerging markets haven't got only to face what happens with China and whether we have growth or not. They also have to deal with extremely high levels of debt that they have been accumulated the last decade in US dollar. So imagine this. They have a situation where growth is slowing down, the Chinese are becoming more hawkish in their policy in their own unique way, and at the same time, US interest rates are moving up and the US dollar is rising. So suddenly your debt that is already in the range of hundreds and hundreds of billions, the interest rate is becoming more expensive. The cost of money is more expensive. So all this environment created a flow into US assets. It created flows into the US dollar. This is why emerging market currencies moved lower. And you can see what the structure is telling us. We broke the rising trend line that had started since 2016. And if you remember back then, around the beginning, the first couple of months of 2016, it was when the Fed decided not to become aggressive with hiking the interest rates. So that was a relief for emerging markets. But now under Trump and under Jerome Powell, it is a completely different situation. So we can see that the trend line is broken. We have moved below the moving average, and it seems we have a strong trend in place. So this is another theme you need to watch. Now let's move on. Emerging market equities. So you can see what I'm doing is I'm trying to stay as less biased as possible, and I'm only focusing on actual data and what is happening in the markets. And I'm trying to interpret the fundamentals practically and identify the themes, the catalysts that can lead to opportunities. So you can see here again, 2016, the main factor that we had the rally in emerging market currencies, in emerging market debt, in emerging market equities was the decision to be more accommodative by the Fed. It was the weakening dollar. But that has changed. Double top, highs of the balance, we broke below, we are now again below the 52-week MA. It is very likely that emerging market equities could reach the bottom of the balance around the 36-35 level. This is an area that I might be interested to do business again and gain some exposure in selective emerging market equities. So, although I am bullish in the long run, in the short to mid-term, I am quite pessimistic and I think we will see lower values in emerging market equities. Why, you might ask? Because of all the reasons I described. The fact that we have a change in monetary policy and different government policies in the US. That China is focusing on the domestic demand and trying to reshape their economy, and they need it to be more hawkish. All of those reasons are shaping the current regime and they are affecting current conditions. So current conditions say emerging market equities are suffering because of what is happening. We have global growth slowdown, and we can pay attention to what is happening with copper to have an understanding where this trend is accelerating, or if we are having second thoughts. So we are using intermarket analysis to understand what is going on, what is affecting behaviors and sentiment. So let's move on. Now, I would like you please to pay very close attention to this one. I explained what I think is happening with perhaps, if not the most important, a very important factor, and this is Chinese economic growth and what is happening with emerging markets, because as I showed you, they contribute the most to global GDP growth. But now let's see some things that you will not find too many reports or views on popular financial media. We have expectations that the Fed, for example, is going to raise interest rates at least twice, at least another 2 times in the future. The Fed also has said that interest rates are still quite accommodative as we are below where the rates should have been. We are below the normal rates. So if they are having such a hawkish rhetoric, if they are telling us that they are going to increase interest rates at least twice over the next few months, look what is happening with the 10-year yields. Now, the Bollinger Bands you can see here represent 4-year cycles. And why have I chosen 4-year cycles? Because they correspond very well with the election cycles. So we have daily intervals that correspond to 4-year cycles. And you can see 1 standard deviation and 2 standard deviation away from the average. Look, for example, what happened back in September 2017 when we found the 4-year average. We bounced, we moved up above the 2nd standard deviation because of a very hawkish rhetoric by the Fed and also the actions of Trump's government. But if I strictly take a look at this from a quantitative point of view, it looks to me more likely to have a correction lower, at least towards the 1st standard deviation, towards 2.6, 2.7, instead of breaking higher above the 3% level again. Again, this is strictly on a technical basis, on a quantitative basis. If I try to interpret this also from a fundamental perspective, I look what is happening in the US economy and I'm just scratching my head. How can they go ahead and aggressively raise interest rates? Yes, they can do it. The Fed, of course, they can raise twice interest rates, but that doesn't change the fundamental conditions in the economy. They can be as hawkish as they want or as dovish as they want when they make their interviews, when they make their statements, but that is not changing some hard economic realities. For example, we have noticed lately that households' disposable incomes and also savings, when I say savings, I mean the ability of households to save money. So disposable incomes and savings are suffering. They are not getting better, they are getting worse. Middle class families found it, whatever is right, excuse me. They found it extremely difficult to save money. They need to pay the bills. Although productivity has risen because also of the advancements of technology, the average worker, the middle class family is not earning more money. So we can see that disposable income and savings is taking a beating. And also we notice that household consumption is moving to a 27-month low of 2.7% on a year-to-year basis. So let's review all that in simple English. People can save less money in the United States. They cannot afford to save money, which is a prerequisite if you wish to enjoy high levels of growth in your economy. We have pressured disposable incomes. We are having consumption at lower levels on a year-to-year basis. It is at a 27-month low. And very importantly, we see that the PMIs might, especially the manufacturing PMI, might be at highs, might be towards 57, 60 inside that area. However, pay attention to what is happening historically. Every single time that the manufacturing PMI was visiting this area above 55, over the next 3 to 5 years, we had a recession in our hand and much lower economic activity. And the most important factor, I almost forgot, and it is the most important, debt is piling up. We had the release of the Congressional Budget Office for 2018, and they said that over the next decade, debt is going to move to 100% of GDP. Up to 2050, we are going to move to 148% of GDP. And what they also said, that the liabilities that the federal government is going to have are going to exceed the revenues. So in this environment where growth seems to be peaking out, we haven't printed any numbers yet to confirm 100% that growth is slowing, but we do have the indications that growth into the second half of 2018 could face some pressures. But we see that in reality, in the real economy, the real living conditions for the average American are becoming worse and worse. How can you go ahead and raise interest rates? Higher interest rates, higher oil prices, which I think could reach the 80 level easily. And where we are in the economic cycle, and if you also consider the valuations in the stock market, create an environment where it is very difficult to go ahead and gradually increase interest rates. What is going to happen if you continue increasing interest rates? We are going to reach a level where the real economy, the real living conditions are going to suffer. And it's not just the United States. Remember, we discussed China, emerging markets. We had news that also Japanese GDP was down minus 0.6 in the first quarter. Let me correct this, the first quarter. In Australia, there hasn't been a recession for the last 25 years. Capital expenditures in the last quarter of 2017 contracted by almost 1%. So we have conditions to suggest global growth is slowing down. It starts from China and it is spreading. In this environment, with inflationary pressures, inflation seems to be moving higher. With interest rates rising, it is very difficult to have a hawkish policy. This is why I suspect that it is more likely the yield to be moving towards 2.6, 2.7, and to have in the second half of 2018 a more important and a more severe global growth slowdown. We had an interesting statistic from Hedgeye. We are doing excellent research. 77% of global manufacturing PMIs are in negative territory. So where is the growth? This is my question. Where is the growth? Now let me move on. Now this is important. This is important because here, based on what we explained before, we could have an amazing opportunity. What you can see is the 5-year and the 10-year US Treasury futures, the bond futures in the US, 5-year and 10-year. And you can see that technically we reached lows back from 2011, 2012. Yields failed to move above the 3% level. The conditions do not suggest that we will just continue with higher interest rates in the mid to longer term. Global growth and the real economic conditions strongly diverge with this, and I can see that price action is moving to the upside. I can see that bonds are moving higher, not lower. Some people, and I am not one of them, I actually believed the opposite. Some people were calling for a strong bear market to continue with bonds. I respectfully disagree. And I think over here, if you pay attention to these levels, we could have conditions for a short squeeze to the upside in bonds. So pay attention to this, because we have heavy positioning to the downside. There were people claiming this time is different, but I think after a correction because of monetary policy, what is happening on a political level, we have a good probability that a short squeeze is in our hands, and you could see bond prices globally strongly moving higher. I think it would be better to play this using options. It will be safer because of the current conditions. But please pay attention to this. This will have an impact also in equities if it happens. But I'm paying attention to this level, especially if we break above the 114, 115, I'm paying attention to have a reversion back to the mean in the bond futures market. So this is the other evidence I'm telling you. If we are going to have higher interest rates and a very hawkish accommodative policy, then why do the bonds move higher? Bond futures are moving higher. Let me show you the next chart. You can see similar behavior also in global bonds. Over here, with this candlestick series, we have EMB, JP Morgan's Emerging Markets Bond ETF. You can see it was inside the big range. It moved at the bottom of the range. But what I was saying to clients and students, I will not be looking to sell down here because we are at the bottom of the balance. Look what happened in 212, into mid 213, into 2016. We have a triple bottom. So I'm not going to bet that this time it's going to break below this. Somewhere around this area, we were looking at a reaction from the buyers, and it has come. You can see on the weekly chart how emerging market bonds is snapping back higher. The same thing is happening over here with this candlestick, and I put these two together so you can see international government treasuries. They corrected lower because of monetary policy, because of expectations and sentiment. So we had the correction, but now bonds are moving back higher again. So this is why I'm saying do not rule out a bull market in bonds with what is happening, because the real economic activity does not agree with expectations and sentiment. This is my opinion. I'm going to be a contrarian on this one. Now a similar chart with the 4-year cycle, also the Eurobond. This is a little bit different and more tricky. I'm not going to do business here because the structure is telling me that we could face resistance into 164, yes, and then move down, which means the yields will be moving up. But because this is more horizontal, based on quantitative tools, that I'm not going to explain a lot right now, we also have the potential to also move to 168 at the second standard deviation of the average. Why am I showing you this? I prefer to trade, because of the structure, I prefer to trade the US bond futures and not the German Bund, but the structure of the German Bund and the potential to move a little bit higher, and in general where we are with monetary policy in Europe makes me being a little bit more bullish with the euro instead of having a more pessimistic view about what is going to happen into the future. I'm going to explain this in more detail. Now let me move to the other chart. This is the S&P. You can see that the S&P, because it is an index more sensitive to international conditions, it is consolidating at the highs. In traditional technical analysis, we have a massive triangle right here at the top. We had the reaction at the 200-day moving average. It is visiting the highs again. What technical analysis is telling us, we should be fading moves to the upside, and this is what I intend to do. Can we have a spike higher? Perhaps another second top, a double top? It is possible, of course. Let's not forget that financial markets have non-linear dynamics, but even in that case, I would be looking to fade that top. Now, why am I saying this? Because the underlying fundamentals and what is happening make me having a very strong conviction about what is going to happen regarding equities. We have negative economic developments. In some cases, we have global growth slowing down, real living conditions are suffering. But take also a look at this. Now, you might say, what is this? I went back to 2007, 2008 to show you the peak, the behavior of the market back then. Actually, let me move to this chart. What I have done is I have here the current peak in the S&P, and look what happened in 2007, 2008. You can see that also in 2007, 8, just before the big crash, we had a double top. We had a correction for a little while below the 200 MA, came back up, tested the highs again, and then the rest is history. I'm not saying that we are going to have exactly the same pattern, exactly the same behavior, but we are going to have very similar dynamics. So I'm expecting that this pattern will turn out to be a top pattern, and we are going to have a much bigger correction or lower. This is important for you. Why? For many reasons. Number one, and this is extremely important, especially if you are into portfolio management and asset allocation, or even if you are a simple pensioner and you are using one of these completely worthless robo-advisors. Why am I saying this? Because you are at extreme risk. If we have a situation like this and global growth is slowing down and we have higher inflation and we have a society addicted to debt and we have massive debts threatening the global economy, usually in corrections like this, when we are moving into this kind of regimes, into this kind of dynamics, what happens is that we have positive correlation between equities and bonds. So how are you going to hedge your portfolio? In the past, if we had some negative returns and equities were moving down, you could just buy some bonds and hedge out the risks from equities. Now let me tell you, you cannot do this now. we are in a situation that because of positive correlations, bonds and equities could move down together. So pay attention to this scenario, because you might be at extreme risk if you are trying to hedge your portfolio using a robo-advisor that relies only on past prices and mean variance optimization. You need a model that it is much more adaptive. So you need to understand the macro fundamental conditions, and also that creates an opportunity. Actually, maybe the dynamics change because of this, and again the bonds become favorable, and we have a scenario where the 5-10 year bonds in the US just strongly move higher. My point to you is this: pay attention to what is happening, pay attention to the narrative that matters the most, understand the narrative, and which are the forces that are shaping the investment regime. This is very important. Right now, with what is happening, because we are at a very important point where the changes are happening and we cannot fully understand what kind of conditions we are going to create in the future. Pay attention to the areas that you are doing business, pay attention to reward and risk, and if you are not a discretionary trader but you are running a small or large portfolio, make sure you have exposure to some smart beta or adaptive strategies. I'm using some models myself, and be more sensitive to current regimes and not rely so much on modern portfolio theory. So these are the risks. So what you need to take from this presentation when it comes to fundamentals, and now I'm going to show you some charts on the currency markets. You need to pay attention to the fact that China is seriously slowing down. Shanghai Composite is in negative territory. That's not the end of it. The worst hasn't come yet. This is affecting emerging markets. That right now creates positive flows for the dollar. So in the short term, it creates positive flows and demand for the USD. But in the future, in the longer term, I'm much more pessimistic about the USD. Why? Because of the huge debt and real living conditions. I see growth, I see the statistics, and I just look at disbelief. I can't believe that they will be able to gradually continue raising interest rates. It will suddenly come to a stop. This is my view. So these are the factors you need to pay attention. You need to pay attention to European politics. Germany is acting more like North Korea. It has some attributes from like an emerging market, and you need to pay attention to this. This is affecting the euro, but the euro at the moment, because of the ECB, because of the monetary cycle, is at completely different dynamics than the USD. Now let's go ahead and look at some charts. Why am I saying this? I think in the mid to longer term, the situation will be better for the euro. And I highlighted here in the charts the fact that we were consolidating at the bottom, just above 115. We had a consolidation, we had an absorption, the buyers were absorbing the offers, and now we are breaking back up. If the US yields are moving lower, that is going to be more positive for the euro because of the ECB and because of the level of the German yields. The downside is limited in my humble opinion. Now we have value area low around 118.50. Pay attention to this level. If we break above this, keep in mind that the high volume node, the large concentration of orders, is towards the 120 area. So that is my target. So this is what I would like you to pay attention. And let me also show you a completely different pattern here in the dollar yen. So short term, this is the balance we are using as reference. The current scenario in the markets with pessimism and fear in equity markets. We have negative news about international trade and G7 trade wars hitting the markets. This is not good for global sentiment. It brings us closer to a risk-off scenario. And you can see this is why in this area we were saying we are looking to sell the USD, not buy this. It is attempting to break now below the value area high of a larger balance. However, keep attention that if it continues consolidating here without breaking below the value area high, if it starts moving higher above 111, that could lead to a significant trend higher. Now, why do I mention this? I am mentioning this because the price action together with the fundamentals will help you understand which theme is in control, which scenario is dominating sentiment, so you can act accordingly. Right now, equity markets moving lower and concerned about international trade and G7 between, sorry, I said G7 between, no, what I meant was tariffs between G7 members is having a negative impact. US yields are moving lower, so the dollar is suffering. However, if we have an extreme scenario in emerging markets, let's see if that is going to cause extreme demand for USD, causing this to jump significantly higher. Now, why is this chart important? Because the point is not trying to guess whether the USD will move up or down. Let me tell you something, it will do one or the other. Yes, the important thing is where are we doing business. So right now, I can see that the sellers are a little bit more in control. I'm paying attention to the levels. I'm paying attention to the value area high level over here around 111.20. However, if it breaks above the second standard deviation, above 111.20, you need to pay attention to the news flow to see if there is extreme demand for USD from emerging markets. So I pay attention to the regime, I pay attention to the scenario, and I pay attention to where I'm doing business in the structure and where I place my stop. If you do this, if you follow this approach, all you need is to do business from the right areas and have appropriate reward to risk. The fact that we rely on fundamental developments and we try to understand fundamentals is giving us an edge because it is increasing our success rate, and we go for high reward to risk ratios. This is the important thing. Next chart, I wanted to show you over here, this is the Euro Stoxx. Euro Stoxx is right in the middle of the bigger balance. I'm going to fade any moves higher, and I'm looking here, we found resistance. Pay attention this week for a move lower in the Euro Stoxx. We are at the highs of the current balance, we have resistance. This is an area where I will be looking actively for a move down, a break away from the second standard deviation of the VWAP. Maybe if we have one last spike, I'm looking here at the value area high. But right now I'm having a negative sentiment. So again, the point is not which direction it will go, but where are we doing business. We need to have statistics in our favor. And this is the last chart I'm going to show you. So let me bring this up. Euro Stoxx banks, the banks in the Euro Stoxx index. Now this is why I am negative about the Euro Stoxx. I can see that banks, the banking sector is moving lower below the 200 MA. It is clearly in a downward channel, and also we had massive outflows away from Vanguard European ETF. The symbol is VGK. Many people mention this, please pay attention. We have this move, this negative move down in European banks. At the same time, if you see again, the Euro Stoxx was at highs. I think, let's see if this is going to drag lower. I'm expecting a move lower. Now, the important thing is that we have explained the process. We have told you which themes we are looking. We are paying attention to China. We are paying attention to the global growth slowing down. This is the theme that we pay attention. We are paying attention to the deteriorating US fundamentals. Some fundamentals are good, but we have other hard fundamentals that are not at all, and we could be at the beginning, at the doorsteps of a larger recession. We just cannot see this yet because it hasn't started, but we could be getting there. The important thing is not whether I'm right or wrong. The important thing is how do you prepare. Be prepared when it comes to your portfolio, and be prepared to recognize the different themes as soon as they hit the news flow. Thank you very much. I hope we will see you in a future broadcast, the Global Macro Edge, here at the Fotis Trading Academy. Thank you. Have a great week.